So first, let's look at the housing market nationally. And I put that in quotes because, when you hear on CNBC or the CNN or one of these news shows talk about the housing market, it's really a bunch of crap. It's just a bunch of numbers and BS for talking heads to talk about. Really, there's no national real estate market. It's not like the gold market or the oil market where it's the same everywhere. Real estate is local, 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 local. That's all it is. It's all about location, location, location. So even if I say the market is doing this nationally, it might be doing something different in Ohio or in California or in Texas. And even if I say it's doing this in Ohio, you could say, well, this city is doing it different from this city. And even if I said everything is going a certain way in Columbus, you're going to say, well, it's not happening in these neighborhoods in Columbus. You understand? So you really have to dial it down to neighborhood by neighborhood in terms of real estate. And we'll talk about what factors to look at in a bit. So if we're going to look at the national market, it's going to analyze things like average sales prices, which really doesn't mean anything on a national level because California versus Oklahoma, right? Different price range. The number of houses sold, which I don't think is that important of a number. Lately, they've been talking about the number of houses sold has dropped dramatically in the last few months. That doesn't necessarily mean anything by itself in a vacuum, because if there are fewer houses for sale, fewer houses will have sold. Or if people are holding out for prices, the days on market is longer. Or maybe there's just a pause in the market because all of a sudden interest rates just jumped dramatically in the last 3 months. So people who are in the buying market are just pausing, I think, to see like what's going on here. Maybe it's not quite yet the right time to buy. So by itself, the fact that the number of houses sold has dropped dramatically in your market or in the national market recently, by itself in a vacuum is meaningless. Okay, it's meaningless. If you're a real estate agent, it's not meaningless. If you're a builder, it's not meaningless. But to us as investors, it's kind of meaningless in a vacuum. There are, however, and there's other things they look at called housing starts. What are those? Those are new builds. Most of what we buy, of course, as investors is not new builds. We're buying used homes and usually older homes. Some factors do affect real estate everywhere that are national. So let's talk about those. Number one, interest rates. Interest rates are the big thing lately, right? Interest rates were sub 3 and now are in the 6 range for investors, as high as 7. Now, people look at that and go, wow, I can't make money with that. That's just too high. That's crazy. Well, let's look back historically. 1979 to 81, during the Jimmy Carter days and early Reagan days, interest rates in residential were, 14% or more. Commercial was over 21% in some cases. And people still made money. Now, of course, can you buy more house with a lower interest rate? Can you make more cash flow with a lower interest rate? Yes. But if we look at the average interest rate over the last 60 years, it's around 7 to 8. So this run of 5 and under we've had for a while is abnormal. It's abnormal. And it's to some extent contributed to the housing boom over the last 10 years, or really the last 15 years, if you look at where interest rates have been. When I got started in real estate in the early 90s, investor rates were almost 10%. And I still made money. I still have loans from the early 2000s that are in the 7s, mid 7s. Now, I only have like 11 years left on a lot of them, 12 years left on them. So it doesn't make sense for me to start all over again with an amortization, especially now that interest rates have jumped to 6. I was tempted when they were 3.5 for investors, but it's not the be all end all. It's not the be all end all, but it does affect demand for real estate. If buyers have to pay more, and by the way, a 6% interest rate versus a 3 does not double your payment. It raises it about 35 to 40%. Okay, it doesn't double. I'm sure what we're going to see next is 40-year mortgages. They were popular a while back, but I think they're going to come back. So if interest rates are 6% and you amortize it over 40 years, then your payment is quite a bit lower. Or we're going to see more interest-only loans and things like that. Maybe even see the old option arms we used to see in the 2000s, where you can pick a payment. You could pick interest-only. You could pick negative amortization, meaning you make a payment and your balance gets bigger, like a reverse mortgage. You can make a full 30-year payment, or a full 15-year payment. I'm not surprised if we would see that. Okay. So interest rates do affect buying power. It affects buying power of buyers. And someone made a good point that we're seeing a lot more ARMs, adjustable rate mortgages. Yeah, I mean, if you only plan on keeping a rental for 5 years, don't buy a 30-year rate. A 30-year rate is expensive. If you get what's called a 5-1 ARM, fixed for 5, then goes to adjustable at once a year adjust, you're going to get a better rate. You're going to get a better rate. So don't always go for the 30-year fixed option. Now, if you locked in at 3% in 30 years, good for you. And by the way, I hate to say this to those who didn't listen to me, but those who sat on the sidelines in the last couple of years and said, I'm waiting for the big crash to buy up. And I said, wait a minute, maybe prices drop 10 or 20% at most, if that. But you're going to have to pay a higher interest rate probably in the future. So was it worth waiting to get a discount of 15 or 20% to pay double the interest over the next 30 years? Do the math on that. You will see I was right. And I hate to say it, but I told you so. So interest rates affect demand of buyers. Interest rates go up, less consumer buyers. However, as I said earlier, we're seeing more institutional buyers because as the stock market gets worse, they run to real estate. So that will take up some of the slack, not all of it, but some of it. Okay. So demand has dropped a little bit. You know, the whole thing is, as an economics major, supply and demand. That's what it's all about. How many houses, how many buyers? If interest rates go up, the number of buyers goes down. Okay. The next thing is the FHA, Fannie, Freddie loan guidelines. So if the government makes it easier to get a loan, even though interest rates are higher, more buyers will participate. If the government makes it harder, maybe they start making you put 30% down, that drives people out. And that's the same nationally because those regulations apply to loans nationwide. And finally, federal tax policy. 1031 exchanges, there was talk about getting rid of that in the early Biden days. That's not going to happen. He's not going to get that done by November. And his power in Congress, we all know, is pretty much over by then. The mortgage interest deduction. During the Trump days, and one of the things I really didn't like that he did with the Trump tax policy was to limit the amount of mortgage interest as a homeowner that you could deduct and property taxes to only $10,000 a year. Now, if you live in a cheap house where taxes are cheap, that's fine. But if you live in Jersey or New York, where taxes could be 35 grand a year on a $500,000 house, no joke, plus a big mortgage, and you could be deducting 50 grand a year, and now you can only deduct 10. That's a pocket loss to those people. So it'll be a disincentive for buyers to want to buy. So tax policy is important.